Okay, hello everyone. Thank you very much for joining me and to follow this video. And I hope that this video will help you to understand for the chapter number one in managerial economics. Okay, and this chapter will discuss about the fundamental of managerial economics, which is our learning objective for this chapter. Uh, is to summarize how goal, constraint, incentive, and market leverage affect economic decisions, and then to distinguish economic versus accounting's profit and cost. Okay, explain, and also we will explain the role of profit in market economy and apply the five forces framework that we as a manager, for example, will apply five forces framework to analyze. For what? To analyze the sustainability of industry profits, and how as a manager we can apply the present value analysis to make a decision and value assets. Okay, and after that how that manager can apply a marginal analysis to determine the optimal level of managerial control variable. And last but not least is identify and apply six principles of effective managerial decision making. So from the list of learning objectives that we just mentioned just now, okay, we can see how important of a manager in order for them to make a right decision in according to limited resources or scarce resources. Okay, that we will discuss more further after this. Okay? So as you can see from the slide, okay, you can see that some overview for our topic that we will cover for this chapter. Okay, the second point there that you have to focus more is a list of principle in order for manager to manage effectively in perspective of economics. In perspective of economic, I believe some of you maybe got some experiences to study management, study of organizational administration, and there are a lot of principle to be an effective management. But in economic, some economists list a few that we can use as a principle to manage effectively one particular for area of economics. All right, and before we go for define a few terms that I think you can see from there. I think they're very straightforward definition. First of all, I would like to review some of question that's normally a student will ask in class, why that we should study about economic. Okay, and what its purpose for us to study an economic. Okay, will it tell me what the stock market will do tomorrow, or will it tell me where to invest my money or how to get rich? Yeah? Unfortunately, all of these questions is not for you to study, and not the purpose of for you to study an economic. Yeah? Obtaining the answers would require for that such a questions, of course, obtaining that answers will require an accurate crystal ball answers. Nevertheless, managerial economic is a valuable tool. It's a valuable tool for analyze business situation, such as the one maybe we can found in a certain Wall Street Journal, or maybe a few headline from the economic magazine, For example, maybe you can found the target to match online price with online rival, how that's Ferrari spin off and generate a few benefit for them, okay. Sadly, billion of dollar are lost each year because many existing manager fail to use basic tool from managerial economic to shape pricing and output decision, okay. And other a few very important and critical decision, okay. And you will also understand why that the last recession was great news to some firm, and why some of the firm spend million on development of maybe in their raw material, for example, maybe we can see some of firm invest a million for them to create their software, and develop their application for the smartphone and so on, okay. And managerial economics is not only valuable to managers of Fortune 500 companies. It is also valuable for manager of non-profit organization, okay. For example, if you are a manager or you are in charge to an organization for distribute the food for needy, so you have to decide and you have to coordinate the very limited resources, and economic we call it as a scarce resources, okay, to distribute your food bank for needy people, okay. So that's why is and then this answer is of some of these question, some of these critical decisions lies in the meaning of the term of managerial economic, so as you can see from the slide now, okay, three terms that we have to remember, okay. What their function and what the definition of manager, what the definition of economics and definition of managerial economic, so as you can see from there, okay, manager is a person who direct resources to achieve a stated goal, okay. So this definition includes all individual who direct the effort of others, including those who delegate tasks within an organization such as a firm, a family or club, and then any individual who purchase input to be used in the production of goods and service, such as of the output of firm, food for needy, or shelter for homeless, and then that's also include individual, that manager also include individual who in charge of making other decisions such as product price or quality, okay. And number two, you can see the definition of economic is the science of making decisions in the presence of scarce resources, okay, in the presence of scarce resources, okay. So resources are simply anything used to produce goods or services, okay. And more generally, we use that resources to achieve a goal, gain. For instance, you can see we pick one example just now, how you as a manager for non-profit and organization, okay, use your anything, your resources to achieve your stated goal to distribute food for needy, for example, okay. So decisions are important because scarcity implies that by making one choice, you give up another. Okay, so a computer firm that spend more resources on advertising has fewer resources to invest in research and development. Okay, that means you have give up another choice. Your research and development spend or choice, you have to give up. And then managerial economic is a study, is a study of how to direct scarce resources in the way that most efficiently achieves a managerial goal. Okay, so when we see from this definition, we will notice it is very broad discipline, very broad discipline, that it describe method useful for directing everything from resources of household to maximize household welfare, to the resource of a firm to maximize the profits. Okay, so the nature of sound managerial decision varies depending on underlying goals of a manager. So since this course or this subject is designed primarily for managers of firm, our focus, the managerial focus, manager economic focus on managerial decision as they relate to maximize a profit, or more generally the value of firm, the value of firm. For before embarking of this special use of managerial economics, we provide some overview of basic principle that comprise effective management. Again, so when I discussed at the early slide just now, okay, some economists at least out few principle. Okay, as we can see from here, I think it's a six principle in effective for effective management. The first one is identify goals and constraint. So this is the first step. This is the first step in making sound decision. Okay, is to have a well-defined goals, because achieving different goal entails making different decision. If your goal is to maximize your grade in this course rather than maximize your overall grade point average, so that's why you have to study, your study habit will differ accordingly. Okay, so it sounds sound decisions making leads to making the right decision. Okay, and then of course, in striking to achieve goal, we often say face a constraint. What the most important constraint that we face, of course, back to our economic decision just now, definition just now, we are facing the constraint in terms of resources. So constraints are an artifact of scarcity. So constraints are an artifact of scarcity. Okay, this is the second step or second principle in to be an effective management. Okay, manager must know, okay, the concept of economic versus accounting profit. Economic versus accounting profit. Okay, so the overall goal of most firm are to maximize profit, or the firm value, and so that's why we have to, before we go for detail, we have to know, or we have to examine the nature of and recognize the nature and importance of profit. So to explain the nature and importance of profit, okay, we can see two type of profit here. Okay, accounting profit and economic profit. Okay, because when most people hear word profit, they think about accounting profit. So accounting profits are the total amount of money taken in from sales, total revenue, okay, or price time quantity sold, okay, minus the dollar cost of producing good or services. Okay, it's very straightforward. So how much you get from the sale, and then you have to deduct from the cost of production. Okay, and it's reported on the firm's income statement. Okay, and so economic profits, okay, you can see from there, okay, this total revenue minus, okay, total revenue minus total opportunity cost. My total revenue minus total opportunity cost. Okay, to explain more detail about opportunity cost, okay, we have to see what okay, the concept of accounting cost, okay, opportunity cost and economic profit. Okay, so accounting costs we can classify as or we can categorize as explicit cost, explicit cost of the resources needed to produce good or services. That's something's explicit, that's something that you can see clearly. Because you take out your money, that means you have to list, or you have to record how much you spend in order to produce your good or services. Okay, that's explicit. Okay, something tangible, something you can see clearly, okay, reported on the firm's income statement. Okay, and opportunity cost is the cost of explicit and implicit resources. See, so this is something maybe different. Okay, something may be different we can see from compare to accounting profit. Okay, the implicit resources, something that you sometimes quite difficult for you to decide which of this is implicit resources that are foregone when a decision is made. Okay, so that's again maybe one of the artifact, an artifact of scarcity. Alright, and then economic profit, total revenue minus total opportunity cost. Okay, maybe we can see that implicit costs are very hard to measure, and therefore managers often overlook them. Often overlook them. Effective manager, however, continually seek out data from other sources to identify and quantify implicit costs. Manager of large firms can use sources within the company, including the firm's finance, marketing, or legal department, to obtain data from about the implicit cost of decision. So it's relate closely. Implicit resources or implicit cost relate closely with your decision or manager's decision. Okay, we can discuss an example for implicit cost. Let's say if you are decided to open a restaurant business, and then your accounting cost about maybe 20,000, and by the end of the year you get 100,000 revenues. Thus your accounting profit are 80,000. So 100,000 minus 20,000, that's accounting profit. Simply you can get 80,000. Okay, so however this accounting profit overstate your economic profit, because the cost include only accounting profit. Right. First, costs do not include the time you spend running the business. Had you not run the business, you could have worked for someone else, and this fact reflect the economic cost not accounted for an accounting profit. So to be concrete, suppose you have worked for someone else for 30,000, your accounting cost of time, okay, uh, would have been 30,000 for the year. Thus, your 30,000 of your accounting profit are not profits at all, but one of implicit cost of the running your new restaurant. Okay, so that mean in this situation, okay, you have to deduct you to get the opportunity cost. Okay, your explicit cost is 20,000 plus 30,000, plus 30,000. Okay, that means 50,000. So your revenue is 100,000. That means in economic profit for your decision to open the restaurant is 50,000. That's what we call as economic profit. So it's explained about the total revenue minus the total opportunity cost. Okay. So the most conception is that the firm's goal of maximize profit is necessarily bad for society. An individual who want to maximize profits often are considered self-interested. So quality that many people views as undesirable. Okay? However, some of that's view maybe we can see a few scholars will argue that, okay, that's profit as a signal to resource holder, where resources are most highly valued by society, and resources will flow into industry that are most highly valued by society. So that's a profit as a signal to resource holder, where resources are most highly valued by society. Okay. So when we study about economy, when we study about economics, okay, let me see to adjust this. Okay, when we study about this subject, some of our decisions influence the level of organization, the growth of organization, and the sustainability of profit. Okay, so if you or other managers in the industry are clever enough to identify, okay, strategies that can yield a windfall to shareholder, okay, there is no guarantee, actually there's no guarantee that this profit will be sustained in the long run. Okay, so maybe in the short run, okay, in the short term, you can get a lot of profit, but the most important thing for organization also, we have to make sure that our profits can be sustained for the long run. Okay, so that's why as you can see from this figure, we can see five forces frameworks, okay, pioneered by Michael Porter. Professor Michael Porter, one of the very prominent professor in strategy from Harvard University. Okay, so he outlined, he introduced the five forces framework, and that five forces framework we can use as a manager. Okay, maybe you or other manager can use, okay, to identify a few factors that can affect the sustainability of industry profit. Okay, the first one is entry. Okay, you can see from there. Okay, that means the new entry from here, okay, is can heighten the competition, can heighten the competition, and can reduce, okay, the margin of existing firm. Okay, so that's why, for this reason, the ability of existing firms to sustain profit depend on how big the barrier to entry affect the ease which with which other firm can enter the industry. Okay, uh, so if too easy for other or new company to enter the industry, that means it will affect the margin and profitability of incumbent company. Okay, for their profit. Okay, so you can see that's why some of the big company like Nike spend a lot of money to make sure they are stand out from other competitor. They are not simply other manufacturer who making sports equipment or sport clothes, sport shoes like others. Uh, so they are develop that kind of strategy because of they want to make sure the barrier for new entry to achieve to their level, to their growth, and to their profit quite far from the new entry. And then power of buyers also can affect power of buyer. So similar to the case of supplier. Okay, the power of buyer industry profit tend to be lower. Industry profit tend to be lower when customer or buyer have the power to negotiate favorable term for the product or services produced in the industry. Okay, and then the substitute and complement. So the level of sustainability of industry profit also depend on the price and the value of the interrelated product and services. Okay, so Porter original of five forces framework emphasizes that the presence of close substitute erodes industry profitability. And then industry, of course, that's this element, industry recovery can affect the sustainability of industry profit. So recovery tends to be less intense, and hence the likelihood of sustaining profit is higher. So in concrete industry, that is those with relatively a few firm. Okay, we can study more about this in another chapter. Okay, that's why we can see the level of product differentiation and the nature of a game being played, whether firm strategies involve a price, quantity, capacity, or quality, service attribute. Okay, that's all impact the profitability. Okay, that's industry rivalry. Okay, and then the power of input suppliers. So industry profit tend to be lower, okay, when supplier have the power to negotiate favorable term for their input. Okay, So supplier power tend to be low when inputs are relatively standardized and relationship specific investment are minimal. So these five forces will affect a lot in sustainability industry profit. So manager must really understand of this uh, factor. So in our discussion of the role of profit, we emphasize that profit signal the holders of resources when to enter and exit particular industries. So incentive will play an important role within the firm. Okay, and then incentive will determine accordingly to how resources are utilized, how hard individual works. And then manager also must understand the role of incentive play in the organization. Okay, so that's why when they really understand the role of incentive and how hard of work individual work, how hard of the resources and how the value of resources are utilized, that means manager have to construct a proper incentive. Why? Because that's proper incentive can enhance the profitability, okay, and of course the productivity. Okay. So we have to bear in mind, okay, when we study about economics, okay, uh, there are two sides to every transaction in the market. That means for every buyer, there must be a producer. Okay, so that's why in this okay, in this section we have to really understand this interaction or this relationship, okay, what we call as a market interaction. Okay, consumer producer rivalry, where consumer attempt to locate low price, while producer attempt to charge high price. That's normal. As a consumer, we are looking for the lowest price in the highest quality, even though that's sometimes quite impossible for us to achieve. And then of course for producer, they are looking for the best profit, and they are tend to charge the highest price. Okay, and then consumer rivalry, consumer rivalry, because of scarcity of good, reduces consumer negotiating power, as they compete for the right to those good. Okay, maybe one of the very good example for consumer rivalry is an auction. We will discuss in the chapter number 12, if I'm not mistaken, the more detail in there. Okay, and then producer rivalry, that scarcity of consumer causes producer to compete with one another for the right to service, for to service the consumer, the customer. Okay, maybe one of the very simple and very good example, like we can see the gas station, or petrol station, right? Okay, same price, almost same location. Okay, so producer must compete with one another. Okay, to get or for the right to serve the customer. All right, and of course role of government also affect the market interaction. For consumer, they must fight. Sometimes they will try to attempt to uh, uh, gets government's involvement in certain price limitation, and for producer, of course, they also they are looking for price higher, maybe price limit, a price ceiling for to be increased by government. So that's the role of government, in discipline the market processes. Okay, now we go for the function of time, in order to make a right decision for investment, or maybe the right decision for you to buy a company. So you have to know, as a manager, okay, uh, we must know the time value of money, that we can calculate through present value of the value, future value. So that's a future, that's a lump sum amount to be received at the end of n period, okay, in the future when the period interest rate is high. So this is okay, the formula, simple formula. Okay, maybe we can show one example here. Okay, try to add one example here. Okay, from the slide you can see an example. Okay, example for future formula for present value. So the present value of future value receive in year, receive n years in the future. So where I is the rate of interest or opportunity cost of fund. Opportunity cost of fund. Okay, so remember, right, the opportunity cost. So for example, the present value, is $100 in 10 years. If the interest rate is at 7%, is $50.83. Okay, so how to get this $50.83? You can put all of this information in our formula. Okay, and this essentially means that if you invested, okay, $50.83 today at a 7% interest rate, in 10 years your investment would be worth $100. I think this uh, okay, this calculation is very straightforward. Okay, and then we move to the present value versus future value. So the present value reflect the difference between the future value and the opportunity cost of waiting. So you can see from this formula, okay, PV equal to FV, future value, minus opportunity cost, okay, of waiting, OCW. So if I equal to 0, not PV equal to FV, that means there are no increment, there are no growth. So as I increases, so the higher is the OCW and the lower the present value. Okay. So present value of a stream of future amount, future value, okay, received at the end of each period for n period. So this is what we call as present value of series. Depend on how many years for us to get our investment. Okay. And then so another one concept. Okay. That's the net present value. And the net present value of income stream generated by project minus the current cost of project. So suppose a manager can purchase a stream of future receipt. So by spending C, that means C got the cost dollars for today. So the NPV such a decision is like this formula. So net present value equal to future value 1, future value 2, future until end of year of that project. So minus 2 the cost, as you spend. So if NPV or net present value, okay, lower than 0, that means you have to reject the project. Okay, if NPV is bigger than 0, you have a choice. You have to choice. You have opportunity to accept that project. So an asset that perpetually generate a stream of cash flows, that's a present value of perpetuity. At the end of each period is called a perpetuity. It's different compare with this. Okay, you know when your project, okay, will end. So how many years that your project will end, and you have just simply minus your cost of spending. But the present value of perpetuity, that means you have to wait until end of each period, or maybe what we call as a perpetuity. So the present value of perpetuity of cash flow paying the same amount. Okay, at the end of a period is like this. Okay, so if we want to see, okay, the present value of perpetuity, we have to use this kind of formula. Okay. Okay, there's a firm value and profit maximization. Okay, the firm value of a firm equals the present value of current and future profit, I mean cash flow. Okay, so a common assumption among economists is that it is the firm's goal to maximizing or maximization profit. So this means the present value of current and future profit. So the firm is maximizing its value. Okay, maybe we can see another one example here. suppose the interest rate is 10%, and the firm is expected to grow at the rate of 5% for foreseeable future. So the firm current profit are $100 million. So what is the value of the firm? Okay, the present value of its current and future earnings, and what is the value of the firm immediately after it pay a dividend equal to its current profit. So the value of the firm you can use from this formula, okay, and put the information given above there. So for the answer number A, can get value of the firm, is $2,200 million. Okay. And for the answer for answer B, okay, the value of the firm on the X dividend date is this amount, okay, less the current profit payout as dividend, okay, or 2,100 million. So after you pay the dividend, so alternatively this may be calculated through this formula. So it's very straightforward and simple calculation here. So we move to marginal analysis. This is one of the most important managerial tool. A tool we will use repeatedly throughout this subject. Simply put, marginal analysis stated that optimal managerial decision involve comparing the marginal or incremental benefit of a decision with the marginal or incremental cost. So for example, the optimal amount of study of this course is determined by comparing the improvement at your grade that will result from an additional hour of study. Okay, so additional cost of study, so the that's the benefit of study or additional study hour. Okay, it is profitable to, if affect to your grade, that means it's profitable to continue to study. So there are lots of control variable involved, in marginal analysis. For example, output, price, product quality, advertising, R&D. And in as a basic managerial question, how much of control variable should be used to maximize net benefit. So in order to get this, net, you have to use this. Okay, net benefit is equal to total benefit minus total cost. Okay, marginal benefit refers to the additional benefit that arise by using an additional unit of managerial control variable. So changes in total benefit arising from a change in the control variable. So marginal benefit equal to changes in benefit by changes in quantity. So slope or calculus derivative of total benefit curve. And then marginal cost, okay, that's a changes in total cost arising from a change in the control variable. So very straightforward as well. The marginal cost equal to changes in cost, okay, by the changes of quantity you produce. So slope or calculate derivative of the total cost curve. So to maximize some of the principle, marginal principle is to maximize net benefit. So of course we are looking to get better profits. So that's why we are looking to maximize the net benefit, and the managerial control variable should be increased up to the point where marginal benefit equal to marginal cost. If marginal benefit is bigger than marginal cost, okay, means the last unit of the control variable increase benefit more than it increase cost. But if marginal benefit lower, smaller than marginal cost, means the last unit of the control variable increase cost more than it increase benefit. Okay. So this is an example of the slope. The geometry of optimization, total benefit and cost. Okay, the slope for benefits, cost, right? And then it's a net benefits. Okay, the slope of marginal net benefit. Okay, so that means if you produce more quantity after the maximum net benefit, okay, it's not worse. So in conclusions, make sure you include all costs and benefits when making a decision. That means the opportunity cost, to get the economic profit, okay, not only accounting profit. And when decisions span time, make sure you are comparing apple to apple. That's why we must do the present value analysis, and optimal economic decision are made at the marginal analysis. Okay, so that's all for fundamental of managerial economic, or the chapter number 1. Okay, hopefully you can enjoy this video, and if anything you don't understand, and you can contact, or we can discuss through other medium of communication like WhatsApp or WeChat. Okay, so thank you very much, have a nice day.